Welcome to the podcast for Monday the 4th of March. Last week it was the turn of the banks to begin reporting their full year results. We heard from most of the major domestic banks, RBS and Lloyds. Generally the banking sector is seeing a retreat in share prices after a very good start to the year, and last week was no exception. Indeed, we saw some quite sharp falls on the prices of banks. In the case of RBS, shares are now down on the year, having been up 13% at the beginning of February. And it does represent, I think, a bit of a trend that's taking place at the moment, that whilst the financials certainly led the financial markets higher during the course of December and January, they are on the retreat. They do tend to be quite lead indicator sectors, so we need to watch this fairly carefully, because I've also seen some weakness coming through in the mining industry as well. Stocks like Rio Tinto, for example, down from 37.50 down to 33.50, that being driven somewhat by data that's coming out from China as well. So there is a bit of a rotation taking place. Not that you will see it in the major indices. The S&P is about 3% off an all-time high, and indeed the Dow Jones is around 0.5% off an all-time high, and that's despite the fact that on Friday there was a failure in the sequester talks to reach a resolution, and therefore those cuts look like they're going to come into place. To put those cuts into context, America has a $15 trillion economy, and these cuts represent about $85 billion. They're going to be felt quite largely in the defence sector. There will be job losses, but the American economy is improving strongly. It's taken on around 150,000 jobs per month, and indeed that's a number that we expect on Friday to be confirmed in the Non-Farm Payroll data. So the economy is recovering strongly with about 2 to 2.5% GDP growth. So the thought of maybe a fiscal drag of 0.5% can be accommodated into a recovering market, and that's why I think the financial markets have looked at this in a fairly benign fashion. So let's just take a look at the diary for the week ahead. Well, on Monday we have HSBC. Indeed, those numbers are just out from HSBC. The headline number looks like a miss on expectations, so the resumption of further weakness in the banking sector is taking place. But really, more importantly, this week we will have decisions out of about 11 central banks around the world who are going to be tabling sort of thoughts on where they're taking their own economies. The important ones for us, of course, Bank of England and the ECB. Now, the Bank of England surprised in the last minute, suggesting that 3 members of the 9 members were going to vote for more QE, a further 25 billion, and that certainly sent sterling further down during the course of the week, and particularly against the dollar, where it traded temporarily below $1.50. This week we'll have decisions from them, not expected to increase QE, but it only takes 2 more members to vote, and indeed one of those members, I think, was on the borderline, so there's a chance of more QE coming this week from the UK. Therefore we need to watch that fairly closely, and certainly keep a close eye on sterling. We'll take a look at the charts. And also on the ECB, I've seen forecasts now for April for a potential rate cut. Of course, what we are seeing right across the globe is further monetary easing, which is helping to drive equity prices in the near term. As I say, on Friday, of course, it is the US non-farm payroll data. So let's just rattle through a few charts. First of all, taking a look at the pound and putting the recent falls into context, this is against the euro, holding around the 115 level. We have seen some euro weakness, and that was driven by the Italian elections, which still remain very much unresolved following the sort of hung parliament from last week. But against the dollar, the weakness is more pronounced, and as you can see, 150.43 did actually temporarily touch below 150 there during the course of Friday's trading. And this is the euro versus the dollar, and showing that euro weakness against the dollar since the elections from last week. In terms of some of the movers around, we've got here the Italian 10-year yields. The peripheral debt markets of Italy and Spain have started to see yields increase as the political instability begins to raise its rather ugly head, and of course we have had some auctions in Italy as well. They've passed sort of fairly uneventfully, but yields are undoubtedly on the increase there, and the prices they paid for that 10-year paper were higher than seen in the course of January. So just need to watch some of these trends at the moment. They're not getting out of hand, but a continuation of these trends will begin to shake confidence a little bit in the roaring equity markets, so need to watch fairly closely. In terms of the equity indices, really just want to sort of show the picture in the UK and also America that charts continue to bump quite closely towards the highs, even though we're seeing that rotation out of banks taking place and out of miners. So the UK index close to the highs. This is the Dow Jones, which has, as I say, bumped ahead of recent highs, and as I pointed out, 0.5% below the all-time high that's been seen on the Dow. The S&P here around about 3% below the all-time high, but moving very closely to that level. In terms of some of the stocks, I just want to highlight the banks. I mentioned last week they came off very sharply, and this is just a demonstration that we've seen probably about a 15 to 20% correction in the RBS share price during the course of the month of February, and likewise not so pronounced in Lloyd's case, but certainly coming away from 55 back down to sort of 51, 52. So that rotation very much appears to be underway. In terms of Killik research, we have put a note out indeed in a stock that's in the banking sector, but it is in America, where we feel much more comfortable with the underlying trends of the economy there. Despite the failure of the sequester talks, there does appear to be some real recovery underway in the economy there, and we're highlighting Wells Fargo, which is obviously a very large bank, $184 billion, puts it up there virtually at the same size as HSBC in terms of its size. So it's one of the largest US banks, 1.3 trillion in assets, and we put a buy recommendation out on that stock this week. As always, ask your broker for a copy of the research note.